Can they see me?
They cannot see you.
Okay, good. Because the camera adds like 20 pounds. And I don't need any more of that. Okay. I'm Dave Byck. As Jonathan told you, I'm happy to be here. Let's go over a little bit before I start this presentation. This is a very informal presentation to everybody out on the World Wide Web listening in. If you give me your email and name, I will send you the log and the presentation and a lot of other stuff as well. So just post it on the forum. Very informal presentation. If you have any questions, ask away. Okay? And we may not follow the script exactly, but you'll get an idea of what I'm talking about. Okay, so the reason you're here is, the reason I'm here is to talk about taxes and the tax code and how it affects you, most importantly, as realtors, and touch a little bit of how it affects your clients as well. Okay? In 2018, the tax world was pretty much turned upside down because a lot of laws came in which affected pretty much everybody. The question is, how does it affect you? So I'm going to go into all that. Hello? Okay. So what happened was, in 2018, the goal was back to a trickle down economics approach, meaning let's give lower taxes to corporations, which in turn the hope would be to have them hire more employees, which I have no idea if it works or not. You know, the media tells you one thing, I don't know what to believe, but that's irrelevant. What I am here to tell you is how the changes affect overall, right? One of the big changes to the taxation is the reduction of SALT. SALT stands for state and local taxes. State and local taxes, your state income tax, as well as your property tax and sales tax. Okay? You used to be able to claim this as a deduction with no cap. That's changed. The cap is $10,000 now, which in Florida isn't that big of a deal because really it's just property tax you're worried about. Sales tax is somewhat irrelevant, and there's no state income tax. But I have clients, for example, in New York and New Jersey and California, where right now they're in a world of pain because they had $30,000, $40,000 between property tax and state income tax, and they're getting to deduct 10, which is somewhat of a nightmare. And you're seeing a mass migration to states like Texas, Florida, Nevada, where there is no state income tax. And hopefully lower property taxes. We just talked about that. So you are going to see a net migration. Are you guys seeing that? People coming in from New York, New Jersey, looking to buy second homes, things of that nature. It's a big deal. It's a big difference. Okay. Okay. I think some dogs are looking for some tax breaks too. Unfortunately, dogs are not tax deductible. If they were, I get more money back. Okay. Anyhow, I'm glad we had this. Anyway, so let's go a little further. Or let's not. Let's not go any further. Aha, okay. Now, who here is dealing with second home buyers? Anyone? It's a big place for them. Okay. A little idea for you, because remember, property taxes are deductible up to $10,000. If you're buying a second home, it's not supposed to be a rental, but when you're not using it, you can rent it for short term. The periods you do rent it for, or your clients do rent it for, they can deduct property taxes on there, which is a big deal. Rentals do not fall into the world of the property tax cap. So I implore you to tell your clients, when you're not using your second home, if it's for a month or 2 months, rent it out. It's going to be a major benefit. Yes? It's a prorated portion. And a second home, you don't want to be pulled in that, mortgage fraud where it's really just a rental, because then you can get in big trouble. We don't want to do that. But you are allowed to rent it for a portion of the year when you're not using it. And for that portion, at least you get a deduction for it. Mortgage interest deduction, I'm not going to spend a lot of time on this because it hasn't changed all that much. It used to be $1 million cap on mortgages total. So first and second mortgages, it's now down to $750. Most clients I have don't have mortgages that high. If they had a mortgage prior to 18, above $1 million, they're grandfathered. Any questions so far? Comments, concerns? Okay. This hasn't really changed. Home equity lines, home equity loans. If you're pulling out money so you can pay off credit cards or go on vacations, you're not supposed to deduct them. If you're doing it to obviously refab your home or things like that, that's fine. Make sense? Okay, this is the biggest change in the tax code for individuals and for everybody. Anybody familiar with itemized versus standard deductions? Everyone has them. Every tax filer has it on something called a 1040, which is a personal tax return. The IRS gives you a little bonus. They say you can deduct against your federal income taxes. You can deduct income. And you do that either using a standard deduction or an itemized deduction. Now, there's a very big difference here. The standard deductions have almost doubled from last year. So when I say last year, I mean in 17, because remember, I'm still stuck in 18 in accounting world. So in 2017, standard deduction for a single filer was $6,300. In 2018, the standard deduction is 12. For someone who's head of household, it was roughly 8,750, and now it's 18. And married filing jointly is now 24, which is about double from where it was in 2017. The goal with this was to have less people itemize their deductions on their 1040 or tax return. Why? Because the IRS has less auditors. They want to put less money towards auditing, so they pay less salaries, right? The other goal is they want to reduce other itemized deductions, which they did. They got rid of all work-related itemized deductions for W-2 employees. So if you're a W-2 employee, anybody has a second job who's a W-2 employee? Okay. If you happen to use your car for work, or you buy work supplies or computers or things like that, which you're not reimbursed for, those are no longer deductible. Now, that doesn't affect you guys because you guys are business owners. But for a W-2 employee, it's not the best situation. Let's get to another thing. Don't worry about that. Okay. Let's get to the meat and potato.
Quick question. What if you were part of the year a W-2 employee and then now not? How does that impact that portion?
Okay, well, you're talking about two different situations where you were a W-2 for part of the year with one job and now you're a 1099 with another job?
Mm-hmm. Correct.
You're treating it totally separately. So any deductions you would have had on the W-2, you're not going to be able to use. On your 1099 from real estate or whatnot, those deductions you can use because you're filing as a small business, which is a total form of Schedule C.
Gotcha. All right, thanks.
Go, Omar. Hey, how are you? Okay. Any questions so far? Comments, concerns? Okay. This is the meat and potatoes of why they created the Tax and Job Act. At the end of the day, they wanted to reduce the taxes on corporations, mainly large ones, so they can bring their headquarters and their workers back to America and create more profitability, having them hire more employees. The highest tax rate for SCorps, companies like Amazon and Google and so forth, was 35% of the corporate level. It was reduced down to 21. That's a huge drop. We're talking about a 40% tax break. Huge. Huge. We're going to make it huge. Okay. So yes, it's a huge drop. We're talking about a 40% tax break. That just goes to their profit, their bottom line. Media says that 400,000 or 4 million jobs were created. I have no idea if that's true or not because no one tells me anything. But that was the goal behind it. Now, so we understand how it affects SCorps and the big boys or girls. The question is, how does it affect you? So small businesses came in and they said, well, this is great for these big businesses. You guys are getting this big 40% tax break, but the backbone of America is a small business. And we don't, pay taxes on our corporate filings, or we pay tax on our personal tax return through either a Schedule C or an S corporation or whatnot. How does it affect us? So what they did is they passed through something called the QBI deduction. Okay, just to make the tax code more complex. QBI stands for Qualified Business Income. And the goal behind that was to give you guys a benefit somewhat similar to the large corporations. Although it's not as good, it's something. The QBI deduction, and there's a lot of different moving parts and components with it, depending on how you file. So if you're a Schedule C filer, meaning that you're receiving a 1099 to your own name and you don't have a PA or an LLC taxed as an S corporation, you get your net income, you multiply it by 20%, and that's your deduction. If you're an S corporation and you make more than a certain amount of money, depending on how you file, if you're married or if you're single, you may or may not have to use the salary portion, which is not affecting a Schedule C, but for a S Corp on how that works. Again, the goal behind the QBI deduction was to give small business owners this deduction, but not give a loophole out. The big concern the IRS had was, if we give out this deduction, we're going to have all these Wall Street and hedge fund people go out and who are W-2 employees. Now they're going to open up their own subcontracting businesses, make $2 million and deduct $400,000. So they put a kibosh to that under something called a specialized services. At the end of the day, I'm digressing. Realtors don't fall into that issue. You're able to do this deduction. Investment houses and things like that can't. So I'm going to go into QBI in the first place. Let's give you an example. And this is not for everybody, because some people, if you're married and making $357,000 or less gross, you don't need to use your salary portion. It's just 20% of your net income. If you're making more than $357,000, you got to have some kind of salary to reduce that. The majority of clients that I'm aware of aren't making $357,000 gross, but some are. So if you are, that's something we can talk about separately. But for the most part, think of it this way. If your gross income is $100,000 and your net income is $70,000 in your real estate business, planning on being able to get additional $14,000 deduction on top of your standard. So think about that. You make $100,000, you have $30,000 in expenses, your net income is $70,000, the QBI is $14,000. Okay, the only time the salary comes into play is if your gross income is more than $357,000 if you're married. $315,000. I have it on here. I can't remember. At the end of the day, this is an extra big benefit. It's an extra big benefit they're giving to small business owners. So it's like, here's your standard deduction of $24,000 if you're married, and here's an additional carrot of, let's say, 12 or 15 or whatever the case may be that goes against your federal income taxes. I know the problem is IRS does not make this easy. There's a lot of moving parts and calculations, so I'm doing my best to sort of explain how the QBI works. At the end of the day, what I want you to know is, as a realtor, if you have a profit, you will get this QBI deduction. Okay? Which is a benefit. If you don't have a profit, then no deduction to get. Correct. Now, if you're an S Corp and you and your spouse are grossing more than $357,000, that's when the salary component comes into play. Okay? If you don't have a spouse, I believe it's $157,000 and $315,000 for married and $157,000 for single. Okay? And we'll get to that in a second. $317,500, $157,000. I was close. Okay. Now, who is able to take advantage of this new QBI deduction? These are all the federal entities that can. You have your S corporations, which in the real estate world in Florida is something called a PA. Anybody have a PA? Okay. Partnerships, which won't affect you guys because you're single licensed realtors. You can't have a partner legally, at least in your real estate business. You may have it in other business if you own a property together or something like that. Rental properties on a Schedule E. So if you own a rental property by yourself and you have a profit on that rental property, you get a QBI deduction for that too. And sole proprietorships means if you're a Schedule C filer, you're filing your real estate business in your own name. So if your 1099 is made out to you as an individual, you don't have a separate tax ID or a PA, this doesn't fall into place. What's missing here? LLCs. You have a question? So here's the deal. Every single business you have, if it's a business, you have the opportunity to get a QBI against the profit. Okay, so if you have a real estate business, okay, and let's say you're a 1099 realtor, you're filing a Schedule C and your profit's $30,000. You're gonna have a $6,000, 20% of $30,000 QBI deduction. Now let's say you have a rental property as well and your profit's $5,000 on that. You have another $1,000 QBI deduction. They're all considered separate businesses.
Even though they own separate tax ID.
Doesn't matter.
But it's a separate revenue.
Separate revenue stream. Correct. Correct. You're all entitled. Am I losing anybody so far? Because it's sort of moving. I sort of get it. LLCs are not on here. Because remember, this is a congressional IRS tax code. LLCs are a state entity. There's no such thing as an LLC tax return. If you're an LLC, you're either filing as a sole proprietorship, you're a single member LLC, you're filing just like you're a sole proprietor, a Schedule C, or you can have an LLC and elect it to be taxed as an S corporation, which in that case, you're filing an 1120S. Either way, you're one of these tax situations. There's no LLC tax return. Does that make sense? Anybody here in LLC? Okay, and then you would fall into the SCorp category. Okay, now, this kept me up at night in 2017 when I couldn't sleep, mainly because the House wanted to get rid of the SCorp benefits. Now, we're going to go over how SCorps work a little bit. S corporations are a different beast than any other type of tax filing out there for businesses. And I'll go into that in a little more detail. The good news is they have not changed anything. The SBA really fought this tooth and nail, and they won, thank God. So S corporation owners are still taking advantage of this, probably the last great legal loophole for businesses. Okay, and now I'm going to go into S corps and explain how this works. Who here files as a Schedule C on their 1040, which means your 1099 is made out to your name individually? Okay. If you're profitable, in other words, if you have more income than you have expenses, you're going to be subject to something called self-employment tax. Now, I don't know if anybody knows what that is, but I'll explain it to you. Self-employment tax is roughly 15.3% of your profits. There's a formula, a little less, but that's about what it is. And what that stands for, self-employment tax, is FICA. So it's your payroll tax, in essence, as a self-employed individual. Social Security and Medicare is 7.65% for an employee and 7.65% for an employer. Because you're self-employed, you're both. So think of it this way. If you make $100,000 in commissions and you have $40,000 in business expenses and you're filing a Schedule C, you're going to roughly spend a little less than $9,000 in self-employment tax. That's before any federal taxes. That's just a self-employment tax, and that's a given that's coming off. Now, S corporations are a completely different animal, and they're taxed a different way. And let me explain how S corporations work. S corporations is a legal entity under the guidelines of the U.S. government. An S corporation has its own tax ID, tax different way. There is no such thing as self-employment tax on an S corporation tax return. The IRS knows this is a loophole. And with the reasonable salary requirement. And what that means is, if you're working your business as an S corporation and you are contributing services to that S corporation, which all of you are, because you're actually going out there and trying to sell real estate, then in fact, you need or should be required to take what they call a reasonable salary. Okay, I like to say reasonable salary is around 35% of your net income. There's no set rule there, but that's what I try to focus on. And let me explain how that affects you from a monetary standpoint. Only your salary portion is subject to that 15.3%. So think of it this way. You earn $100,000. Okay? You have $40,000 in expenses, business expenses. Your profit again is 60 grand. Instead of paying 15% on that 60,000, we're going to say, okay, let's take a salary of 23, roughly 35%. And you're going to pay the 15% on the 23, not on the 60. That's a big difference. You're talking about, instead of $9,000, you're talking about $3.5 grand, $4 grand, which is a big savings there, right? So the IRS is now looking for people who are not taking salaries on their S corps. If you have an S corp, you're filing as an S corporation, you're not taking a salary, you will eventually be audited. In fact, on the S corporation tax return, now they're asking, is the owner taking compensation? It's a very easy thing to find out if you're not. And they know if you're not, you're probably, you're cheating, if you will. So you have to, look, there's definitely an advantage here, a monetary significant advantage, but you have to play by their rules. Because what you don't want to happen is them to turn around and say, you're not taking a salary, therefore we're going to recategorize all of your profits as salary. And now you have no benefit of being an S corp in the first place, from a tax point of view. Everybody with me, sort of, maybe?
When you mentioned the 35%, that's 35% of your net profit, correct?
Of your net, correct.
Okay,
So,
thanks.
example, if you have $100,000 in gross commissions and you have $40,000 in business expenses, your net income is 60, 22,000, 23,000 for a salary should be fine. Okay. We're going to go over salary in a second because usually that's the biggest hiccup. People hear salary and they get very concerned, especially in your business. And the main reason that happens is because sometimes you can't take $2,000 a month, because sometimes you have months that are great and sometimes you have months that aren't so great. Because everybody knows in this room, when you're a realtor, your income isn't like this. It's not straight line. It's up and down. You know, one month you have 3 closing, the next month you're advertising and showing you have contracts, but they haven't closed yet. Right? Yes. Mm-hmm.
But let's say you use September, October, see how you're doing, and then designate that number. All this money is paid prior to September, so qualify for this benefit.
We'll go into that on electing an S corporation. It's sort of sticky, so you have to be smart in how you do it. If you're waiting to the end of the year, October, November, and then say, okay, for the year I want to be an S corporation, the IRS is probably not going to be thrilled about that. Yeah, that's a little better. Okay? I wouldn't do it past August because now it's getting, in theory, you could do it, but what you'd have to do is take all the money you've earned and push it through the S corporation. Yep. Okay. Any questions online? Okay. So let's go into the wonderful world of S corporations and a little more detail on how this all works. Now, I have 3 different scenarios in here, which compares 2017 to 2018. I'm not going to go line item by line item. A, because you're going to fall asleep. And B, because there's a lot of numbers here. All I'm going to tell you is these are Jane, for your example, 1 is Jane the realtor, and she made the exact amount of same income, and she had the exact same expenses. The only difference was Jane in 2017 was a sole proprietor, filing as a Schedule C. And in 2018, she was a PA S corporation. And the savings are significant. Significant. And I did 3 different scenarios because not everybody has commissions grosses of 150. So here I have John, who's grossing 100, and Beth is grossing 50. At the end of the day, simple mathematics, because this is all math. If you're netting meaning that after your business expenses, 20,000 or more, you will save money as an S corp. It's just mathematical fact. Even with the cost of filing S corp tax returns and doing payroll, you'll still save money. If you're not netting $20,000, you're probably not ready to be a PA or an S corp yet. So there's other reasons to become an S corp or an LLC. A lot of people ask me what's better, an LLC or an S corp. I'll get to that at the end, and we'll discuss the benefits, the non-benefits, or is non-benefits even a word? And we'll go from there. But I'm here to save you money. That's my goal. I do it with a lot of different realtors, many with Keiko. I created this tax plan, and I call it the IRS Tax Plan. It's not something the IRS gave me. It's just 3 letters I use to stick it to them. And it's an acronym. So this is how it works. You have to incorporate. You have to keep good records. You have to take a salary. Think of this as a 3-legged stool, right? If you sit on a 3-legged stool, there's only 2 legs. You're going to have a world of pain because you're going to fall on your butt and you're probably going to, break something. Who knows? These 3 things have to be there. The easiest one of this is the incorporation because you do it once. Now, incorporate could mean opening up an SCorp or a PA or opening up an LLC and having a tax as an SCorp. It ends up being the same thing from a tax point of view. But you have to do this. If you're not that, then you can't get this benefit. Record keeping is monumental. This is the one that's going to keep you out of the most trouble, keep you most organized, and hopefully allow you to find what deductions or maybe more deductions that you normally wouldn't have. And most importantly, if the rare case you are audited as an S corporation, this is what's going to help you keep those deductions. If you don't have good records, it's like, wearing a loose pair of pants with no belt. Eventually, it's going to fall right down, and no one's going to help you pick them up. Got to have good records. It's really, really important. What are you guys using right now for record keeping? Anything? Excel?
So I have a quick question about record keeping. What if you use a single individual business account, single individual business credit card? Does that suffice, or are you supposed to keep hard copies?
I think it's good to do that. I like that you're separating for business purposes. I think that's really smart and what you should be doing. The IRS, God forbid you're ever audited, they may ask for actual receipts. So try to keep your receipts if you possibly can. But again, if you at least have some kind of proof, it'll help. Especially when it comes to mileage, you really should be tracking your mileage. Really, really important because that's, especially as a Schedule C, that's the one thing the IRS loves auditing. They love auditing mileage. But yes, to answer your question, if you are keeping all of your business expenses on a credit card and one bank account, you're not commingling, you're significantly better off. Try to keep the receipts if you can. Some people use QuickBooks, some people use Quicken, some people use Excel. Those are all fine. I have no problem with any of those. Yes? Yeah, they don't care if it, as long as you have some kind of copy or proof, that's totally fine. Anybody track their mileage? Yes? Diane? You use a mile IQ? Okay, that's fine. Any of those are fine. Even if you do a log on Excel and each time track your mileage, make sure you track where you went, why you went there. Okay, if it's business related or if it's not business related. The problem with the Schedule C, anybody who's filled one out, you actually have to tell the IRS the exact amount of mileage you drove for business. Now, you're pretty much telling the IRS at that point, here's exactly what I did. I'm an open book. And when they come to audit you, if they do, they're going to say, hey, you drove 12,746 miles for business. Prove it. Because now what happens is you're giving them an exact amount. And now they can hold you to the fire and try to get you to prove that number. So you really need to have the records to prove that because mileage is one of your bigger deductions. No such thing as a standard deduction on any Schedule Cs. No such thing. I mean, once you're in the audit process, you can negotiate. And you can, depending on how good or how mean your auditor is and how good your representative is, you may be able to get something. It all depends. Some auditors will say, you have no proof, I'm not giving you anything. Others will be like, this doesn't seem reasonable, maybe we'll do this. It all depends. But at that point, you're in the Wild West to whoops, and you're hoping. And nobody wants to hope. So it's really important that you keep that record.
So I had a quick question about the incorporation. Yes. I don't know if you're going to go over this later, but the PA and LLC, both can be classified as S-corps for tax filings. Is there benefit to one over the other?
Yeah, I'm going to get to that, but I'll tell you real quickly from a tax point of view, if you're filing as an S-corp, as a PA or LLC, it's the exact same thing. If you're having,
that's what I thought.
If you have an LLC and it's not classified as an S-corp, From a tax point of view, you might as well not have an LLC at all because you're going to pay the same thing as a 1099 Schedule C. Does that make sense?
Yeah, that makes perfect sense.
Okay, and the world of salary. This is the one that gets people. And it gets people because A, they don't really know what a salary is. Some people think it's just writing yourself a check and on the memo saying salary. That's not a salary. That's just you writing a check and calling it a salary. A salary means that you're paying payroll tax on that salary. Okay? So you're treating it as a salary, and at the end of the year, you're going to get a W-2 from your business. Now you're the business owner, and you're also the employee of the business you own. And you get a W-2 showing the salary you've taken, the federal withholding if you did any, which I recommend you do, and the payroll tax you paid. Okay? In order to take a salary, every quarter you have to file something called a 941, which is a payroll tax return, an RT6, or a unemployment tax return with the state of Florida, or they call it reemployment now. And at the end of the year, you have to file a W-2 and a W-3, and then if you're an S corporation, an 1120 S tax return or an SCorp tax return. Salary is funny because it's a moving. I'll get back to that in a second. Let's go to salary for a second. Anybody who is an S corporation, whether you're online or here right now, if you are taking the exact same salary every month or every quarter in your business, something is wrong. You should never be taking the exact same salary because your business is like this, up and down, and like a roller coaster, up and down. No one here, unless you're maybe doing real estate management or whatnot, is earning the same amount of money each month or each quarter. Your money is your income is gonna shift based on your closings and what's going on, what you're selling, and things of that nature. So remember I talked about that 35% net income? In order to truly figure out what your salary should be, you should be using one of those logs or Excel or something like that, where you can look at what your income is, look at what your expenses are to figure out what your net income is, and then figure out what your salary is from there. Salary should not be a guess. It should be a percentage. If you have a month where you have more expenses than income, no salary. We're not going to take blood from a stone. You'll catch up on the months where you have a lot more income than you have expenses, and that's totally fine. Any questions so far? Yes.
What if we choose to take our salary at the 12th month?
Well,
And only the 12th?
the answer is the IRS doesn't care. That's totally fine.
So it's okay, because you were saying don't make it the same month or week or whatever. But
At the end of the day, if you want to file 3 quarters of zeros,
exactly.
and then the 4th quarter in December, you're going to true up and catch up and take your entire salary for the year then, you can do that. That's totally fine, just as long as you have the wherewithal and the discipline to have the money set aside to pay for the payroll tax for that entire year and whatever federal withholding you should be doing. So is it legal? Yeah, of course. The IRS doesn't care when you pay it, as long as it's still within that calendar year and you're taking a salary for the year.
And it's not a red flag for not.
No. I have plenty of Wall Street types who take, they're on SCorp, so they take a salary once a year because they get big bonuses at the end of the year. Totally fine.
Okay.
But as long as you take the salary, that's the most important part. It's got to be reasonable. Your W-2 has to be reasonable versus your distributions. In S corporation, you have 2 different ways of making money. You're making money because you're pulling money out of the account based on your salary or your income, classified as salary income, or you're pulling money out of the account, which is not considered salary, and that's called a distribution or distribution of profit. Distributions of profit are not subject to the 15%. That's the loophole. They're only subject to the 15% if it's salary. It's a big difference. We talked about this a little bit. If you don't take a salary, they kind of reclassify all your distributions as salary, which is going to be a pain because you pay penalties and interest and everything else on top of it.
Is there any gotcha with that distribution model? I mean,
Sorry?
if you take a salary, minimal salary, and then you do a distribution, is there any gotchas with that?
Well, if we say minimal, then there could be a gotcha. If you take a reasonable salary, there won't be a gotcha. So if you make $100,000 in net income and you take $1,000 salary, yeah, there's going to be a gotcha.
Yeah. Yeah.
If you have $100,000 $100,000 in net, you're taking a $35,000 salary, I'm fine with that. Yes.
Gotcha.
Distribution, only because something like that on the side. Is there any capital gain tax that happens?
No. Capital gain, okay, distribution is just, no. The only time you have a capital gains tax is if you buy something and sell something. A distribution is you're pulling money out.
Right, and no additional taxes when you do it because you're already paying the federal tax.
You're paying the federal tax at the end of the year on your profits, regardless. Okay? I can go into retained earnings and things like that, but I'm going to lose everybody, so I'd rather not do that. At the end of the day, no, there's no capital gains unless you sell something. Distributions, again, okay, let's go back for 1 second. Think of an S corporation as a separate beast. You have $100,000 in income. You report on your S corporate tax return. You have your expenses, your mileage, and your auto expense. Maybe you're depreciating your automobile. Who knows? We'll see. And then you have your realtor dues, and you have your advertising, and the list goes on and on. And your $100,000 in income goes down to $60,000 after those expenses. And let's say you took a $30,000, $20,000 salary for the year. 60, 10%. Yeah, $21,000 salary. That comes off as an expense to the business. Whatever's remaining is considered profit. And the profit is passed through from the S corporation to your personal and taxed at your personal tax rate. Now remember, you get that QBI deduction too on that profit. So your tax will be a little lower. Salary is reported separately on your personal tax return as wages. Okay? The S corporation is never taxed federally at the S corporation level. It's called a pass-through entity. Everybody understand that? Any questions so far? Concerns, comments, jokes? Jokes in La La Land? Anything? No? All right.
What if you're combining mission and investment?
Normally, what I tell clients is if you're acting as a realtor under your real estate license, you want to keep that separate. Plus, if you're buying and selling properties, I tend to tell people to put those properties in LLCs for safe purposes. The PA and the S Corp is attached to your real estate license, and it's really based on your commission income from your real estate. Now, if you are buying properties to rent out and buying properties to rehab and flip, that should be a separate entity altogether. It doesn't have to be a PA. It's not associated with your real estate license. It's an outside business activity. Mm-hmm. Again, if you're netting 20, you're about there. If you're making less than that, probably not. Again, depending on what you're doing, if you're doing full-time work, buying houses and then turning around and flipping them, you're talking about capital gains taxes. It's a little bit of a different beast altogether. I would recommend that going into an LLC, preferably a multi-member LLC, if possible. The investment houses. And preferably, I mean, if you want to get into, okay, we'll step away for a second. What's that? It depends. We're getting into real asset protection stuff here. When you're dealing with properties, when you ever have tangible property, if you own a tangible property, let's say a piece of real estate that you're renting out, okay? And now you have another piece of real estate you're renting out too. I know if it's me, I'm going to keep each of those separate under separate LLCs. Because if someone goes after one LLC and then both properties are in there, guess what? They're going after both of them. So you want to keep them separate. Does that make sense? Yes. Sure, you can always change anything. No, it's just all you're doing is changing the ownership. It's a deed. You're just reporting it a different way. Yeah, exactly. It's just Now, all you're doing is changing the structure of the ownership. The IRS is going to know because it's going to pass through that she's still the owner. Yes.
If they're owned by, the properties are owned by private properties are owned by two of us, one of us doesn't.
What you want to do is a multi-member LLC. It could be a Florida-based LLC, and you could have two different members. That's totally fine. Doesn't matter. I have clients who live in Colombia who are partners in LLCs. That's fine. I got off the beaten path for a second, but back to the world of taxation. Guys online, can you see the slideshow? Well, anyway, if you can, this is everything you need to do to file, to be a PA or an 1120S S corporation. These are all things you do need to file each year. I can't stress this enough. If you're making $20,000,
yes, we can do that.
It's not a question; it's a fact. If you're doing outside businesses, do not put it under your PA because that's attached to real estate license. Do it separate. Okay. These are the advantages of owning or operating as a PA or an LLC taxed as an S corp. You will have lower taxes because you're paying less in payroll tax or self-employment tax, I should say. You're going to greatly reduce your chance of an audit, especially now. Schedule A's or 1040s for W-2 employees, they can no longer itemize their work deductions. So the individual area of the IRS that audits is going to focus on self-employed Schedule C's. They're going to focus all their attention on them. The business side of the IRS is too busy dealing with Google and Amazon to worry about small S corporations. When you're a PA, you do have asset protection. So God forbid you are being sued because you misrepresented, because you thought you didn't tell someone there was Chinese drywall because you didn't know, and they turn around and sue you. Well, if you operate as a PA, they can't go after you personally. Okay? If you're operating as an S corporation, I told you before, you need to keep good records because you can't figure out your salary unless you do. So it keeps you more organized. You also have to have a separate bank account because your PA is going to receive the income. They can't pay you as an individual. They have to pay your PA. Okay? So that's a good thing. Some people say it provides more credibility having PA after your name. I don't know if that's true or not, but that's what I've heard. Okay, lowering your chances of an audit. This is not just me telling you this. This is not just hearsay. This is the IRS giving you statistics, and they do it every year, usually, a year or two out, because they're still auditing 17 right now. But 16, most of their audits are done, and they produce something called the Internal Revenue Service Data Book, and they do it every year, and tax dweebs like me actually look at this stuff. And what it does is it tells us what percentage of types of tax returns are audited, okay? And every year, it's pretty much the same thing. If you're looking at this, you see why I boxed without a PA? If you're a business return, is there a personal return that has a business, okay, which means chances are it's either a Schedule E, you're filing as a rental property, or the Schedule C, meaning you're a small business owner, sole proprietorship. Your chances of being audited are roughly about 2.2%, 2 out of 100. Doesn't sound like a lot, but think of it this way. If you didn't have a sole proprietorship and you're just a regular W-2 filer, your chances would be about 0.2 or 2 out of 1,000, okay? If you are an S corporation, you see at the bottom where it says non-taxable returns? You can't see it, but it's in your folder over there, but non-taxable returns. Remember I told you, S corporation tax returns are not taxed. They're informational tax returns only. The chances of being audited for an S corp is 0.3%, 3 out of 1,000. That means 3 out of 1,000 S corporations have been audited for 2016 versus 2 out of 100 Schedule C's. It's a huge, huge difference. And I can tell you, I do a lot of audit representation. And I got into the real estate world because most people a lot of the CPAs who were giving me people to represent were realtors. And I said, how can I get in front of this instead of always being on the defense? And the answer is choosing a correct business structure. Make sense? I mean, pretty much you're being able to avoid a problem and save money just by choosing the proper business structure. And this is not me saying it. These are just facts. So it's truly a win-win scenario. If you're disciplined and you're making more than $20,000 and you're willing to do it. Now, realtors who are just starting out and they're not sure if they're going to be doing this full time and they're part time and they haven't made money yet, do not go out and rush to open a PA. Make sure this business is for you when you're ready to go. And as you start making money, we should definitely talk. Real estate is not for everybody. So, it's hard work. That being said, what questions do we have so far? Yes.
Wait, can it be still tax related, but outside of the scope of what you said?
Absolutely.
Okay. So concerns about being over the QBI limit for phasing out.
Okay.
And retirement. Like folks do, like Fidelity, and there's different plans. Some is heavy, some not.
Okay. You're talking about 401ks and non-401ks and things of that nature.
IRS, SCP, yeah.
SEP IRA, sure. Okay, well, here's the good news. As a business owner, there's no caps for solo 401ks or SEP IRAs, regardless of your income. Okay, so you can do that through your business. You can put more money in a solo 401k than you can in an IRA or SEP IRA. That being said, that's your choice. Okay, some people don't want, there's a little more administrative in a solo 401k. But if you find a good company to work with, usually they're not that bad. Solo 401ks, you can put a lot more money in because you could defer all of your salary and a portion of your profits. SEP is just based on your salary. We're getting into.
So it's a percentage of my salary. So SEP is based on a calculation. No cap.
There is a cap, but it's 25% of your salary.
Okay, no cap. And I don't think I went in 401 because there's a lot of administrative.
For solo, it shouldn't be that bad. If you go to Vanguard or something like that, a solo 401k should.
All right, and then would that then reduce this taxable income?
Yeah, because QBI is based on, because you're having tax deferrals, so the QBI deduction is going to be based on your gross after expenses. That's an expense to the business.
I'm sorry, taxable income is over, say, 157, right?
Okay, if you're single,
Right.
and you remember your gross income.
Right.
Okay, after I say gross, it's your net income after your expenses prior to those standard deductions and everything else.
Okay, got it.
Okay, so yeah. Now again, if you're above that 157 or 157, you're an SCorp, you can still do it. The only difference is you either get 20% of your net income or 50% of your W-2 income that you take, which is ever lower.
Okay, so just for clarification, so the 317 or the 157 is based on net income.
Your net income,
Minus business expenses.
right, but remember, it's your total global income. So if you have a W-2 from somewhere else and you're earning $100,000, you already have $100,000 there.
Understood, but if it's just from real estate.
If your only income is from real estate,
It's not on gross commissions, gross commissions.
Your net.
Minus that. Okay.
it's whatever is going to be reported on your 1040.
Can't be exceeding that.
And it can be, but then it's a different structure. It'll never phase out for you. Realtors are not considered specified trade. So that's what I was saying. Only specified trades phase out. Specified trades are things like investment advisors, doctors, attorneys. For you, there's no phase out, but you have to use the salary portion.
Do you recommend it used by maximizing, I know pretty a lot of us a little bit about Roth IRAs,
Mhm.
find those things up around pretty complicated. Do you advise maximizing your Roth or
So if you have the money aside to do a Roth 401k, and you're not tax sensitive, that's the way to go. Because then all that growth is tax free. Mhm. If you're a Roth 401k, it doesn't matter. A Roth's a Roth. Right. Then you don't know. I mean, look, you're going to have growth and was never taxed, but you don't know what the tax rate's going to be down the road. So if you qualify for the Roth, I like the Roth, but realize that you're not going to get a tax deduction right now. But all that growth is tax free. It just depends how you want to look at it. If you need the deduction, you need a deduction. The hardest part of this S corporation thing is be the first few months of getting used to it. It's like riding a bike. You know, when you first get on, oh, it's shaky, you're gonna fall off, you're not gonna, well, what is all this crazy stuff? And once you start getting used to it and you follow your first quarter 941s and your RT6s, and then you're tracking your income and expenses and you're sort of figuring out, oh, here's what I have to do each quarter, and here's how the salary works. Now I'm paying money in. I'll tell you right now, my clients who are realtors love right now because I'm doing the tax returns, and for the first time, they're not owing money. And they haven't done any estimated taxes. They're just doing their salaries. And they're doing withholding I told them to do. And now instead of having all this estimated taxes they have to pay, they don't, that ship has sailed. You don't have to worry about that. It's a beautiful thing. Yes?
And they will probably end up being hard for you or any tax professional. But not that I use you right now, but so I did the, as you can tell, I filed as SCorp. And I was so busy focusing on my business and everything else that I failed to meet deadlines, file my 941s timely, do my unemployment reporting. So I'm finally catching up, and I'm getting hit left and right with files. So it's a great thing because you will save money, but maybe try not to do it alone.
If you're late, if you file 941s and RT6s and 1120Ss and those other stuff late, the penalties aren't pleasant.
No, they're not.
So the IRS is a stickler for deadlines. The first quarter 941 is due by April 15th. If they get it April 16th, you're probably going to get a nice love letter in the mail. That's just the way it is. So if you're dealing with an accountant, preferably someone who knows what they're doing, does all this work for you. I mean, you can do it on your own. I probably don't recommend it, but sure. Or you can use paychecks, but they're never going to tell you what salary to take. They're certainly never going to tell you what to withhold. They're going to say, oh, what are you claiming? I'm going to claim married one. Sure, absolutely. But, you know, again, I've had clients who've used paychecks, and of course, they're just taking their $3,000 a month salary. And now when they have a month that's horrible and they can't afford to pay the payroll, they're in issues. Paying $49 a month. For payroll? No. I'm not talking about paying $49 a month to paychecks. If you're taking a $3,000 salary each month, and you have 1 month where you had a horrible month and you're spending money on advertising and everything else, and you got to pay your FICA tax and your payroll tax and everything else, why are you taking a salary that month if you're losing money? Okay, and then how much are you supposed to take each month? If you want, okay, so look, if you want to pay $600 for payroll, I keep going at it. I think you're getting ripped off, but that's your call. I charge $1,200 a year for everything. $100 a month covers everything. It covers all filing a payroll, the S corporation tax return, the personal tax return, all the filings, period. So that's how it works. You can go the paychecks way. That's totally fine. And then you pay someone separately to do the S corporation and the personal, or do it yourself. Okay. $1,000. That's how it works. Any other questions so far? Comments, concerns, thoughts? Okay. Anyone online?
Nope, all good.
Okay. I think this wraps us up. If you want to see me after this class and talk in more detail, I'm happy to do that. Otherwise, I think this is pretty much everything. We talked about the three-legged stool. We do have an app coming out called RepTax. It's the first app that will strictly meant for realtors that will track all of your expenses, all of your income. It's going to be able to also recommend salaries for you and everything else. If you're an SCorp, or depending on if you're not an SCorp, that's fine too. It's going to tell you when you owe federal taxes, your self-employment tax, or your payroll tax, everything.
I think that somebody does have a question.
It's called rep tax. It's coming out shortly. Hello, Deborah. Oh, hold on. I can't hear you. Sorry. 1 second. Yeah, so rep tax stands for real estate professional tax, and it's going to do most of the heavy lifting for record keeping for you. So you attach to your bank or your credit card accounts, and it's going to actually decipher what your expenses are. And from there, the goal obviously is to figure out, take care, to figure out what your taxes are due. You're not an S corporation, we can benefit from it. It comes with the state. If you are an S corporation, what's the credit? Who is it?
Shopping ice.
Avon. Okay. Any other questions, comments, concerns, thoughts?
Where are you located?
I'm located in South Florida in Palm Beach County. I cover people in 47 states currently. Most of my stuff is virtual, but I am in Palm Beach, Lake Worth, Wellington area.
Okay. Can you send us your address and everything? I couldn't hear you. Somebody's pounding their head on the ceiling.
Yeah. You can just enter your name and email. I'll send everything to you.
For some reason, I have so much stuff.
Yeah, I'm sorry. Yeah, I wouldn't push it past then. That depends on Florida. You're taking anywhere from 2 days to 10 days, depending on how long it takes for the PA to be approved. Yeah, lately they've been really slow. I don't know why, but maybe they're understaffed. Oh, that's just, once you do the PA, get the PA approved, you apply for the tax ID number, and then you have the S corporation classification status, and then you're on and going. You can't get the EIN number until the PA is approved by the state. Yes. Yeah. And then what's going to happen? Correct. So, with DVPR, the most important thing is you have to register your PA. Your PA has to be exactly matching the name on your license, comma, PA. And then you register with DVPR, you give it to the back office, and they should be cutting checks from now on to the PA directly. Correct. Mm-hmm. That's between you and them. And if not, we'll figure that out. You can move it over. I charge $300 for everything. That includes all the filing fees, DVPR fee, everything. To do what? Well, there's an annual fee. I think it was $150 to keep the PA open each year. That's what Florida charges. I call it the Florida extortion fee. You go online, you pay, and you leave. That's it. It's called an annual report, which you have to file each year to keep the business open. You're welcome. Anything else? Oh, look at that. Okay. If we work at home full-time, should we be paying mortgage and maintenance fee? No. Okay. You have to pay your mortgage through your personal. Don't pay it through your business. Now, we can do a home office deduction which is totally fine because you work from home. But pay your mortgage and your property taxes through your personal. Okay. I'll send that to you, no problem, Terry. What percentage should the salary be of net income? I like being around 35%. Tops 40, give or take. Is it okay to take a minimal salary, then pay a bonus? Again, as long as the bonus is paid as a salary and you're paying payroll tax on it, I'm fine. Again, certain months you don't have to take a salary. Okay. What if you're taking commission from the outside activity? Assume that would then go into the... again, you really want to keep the PA with the real estate business, and the activity should be separate because it's attached to your license. Deborah, email me and I'll discuss that with you. It depends on your scenario. Just email me your information. What was the question? Arena and Alan, you have a question? Oh, oh, sorry. Pounding in the back. Okay. What do you charge? Tammy, again, give me your email and I'm happy to call you or contact you. The charge for the PA is $300 one time. Set up. Okay. Lovely. That was easy. No, you're welcome. Anything else? Questions, concerns?
I texted you.
Ah, yes. That was you. You have very good questions. You're definitely ahead of the curve because you're already structured.
Yeah.
Can I take this off now?
Structured, but not organized.